joining me today, and I'm excited to always talk to Chuck Chamness. He is the prior president of NAMIC, the National Association of Mutual Insurance Companies. Currently, he sits on a number of different boards, including the WSRB board, which we are extremely happy to have him be part of our team as well.
Thanks, Brian. It is great to be here. Thanks for having me.
You bet. So let's start off with not an easy question, but kind of a general question. Tell us about mutual insurance and why it matters in our world.
Well, it matters a lot. Mutual insurance, obviously, it's something I love, dedicated my career to. 26 years at NAMIC, 18 as CEO until I retired. And by the way, I'm listed as former CEO. You said I'm like departed CEO, but I'm retired CEO. That's better.
Okay.
That indicates leaving voluntarily.
Yes, I hear you.
Which I think is important, but no, it doesn't matter really. It's been a little over 2 years since I retired from that role. Left it in great hands with Neil Aldridge now as the CEO, and a great team there doing incredible work for the mutual insurance industry. But what is the industry? I mean, it's about 40% of the property casualty insurance market. It really, in my view, is the bedrock of the P&C market. These are companies that are committed to their geographic areas, often, one state riders, even smaller, few states, regional mutuals. They're not going anywhere. They are where they are. As you know, and you've worked with mutuals in the Pacific Northwest, there's nothing like that dedication they have to the markets and the policyholders they serve. And there's a reason for that. The mutuals are owned by their policyholders. So it's not the kind of ownership like a stock. You can't trade it or sell it, but you do have certain governance rights. And so it's a special relationship, and it's a long-term relationship, which leads to the long-term nature of the mutual insurance company, which is more than 80% of them are over 100 years old, which is really a record that you can't find, I don't think, in any other industry on the scale that we have.
Agreed.
So they're long-lived. They know their markets very well. They're dedicated to their markets. They have great histories, and they're aligned with their policyholders. So given their ownership, they don't have to worry about delivering a return to stockholders. They simply, focus on their policyholders and serving them through, providing insurance and paying claims and staying financially viable, so they can do that over the long term.
That's a good introduction. Yeah, as you said, I've been lucky and fortunate to work for mutual insurance carriers, and that longevity does tremendously help them with a different picture than a quarterly stock, stock call or whatever.
Absolutely.
So now you're in the industry still. You're still on boards, and you're still working with various insurance companies. How are things going when you look at your corner of the insurance world or our corner of the insurance world today?
Well, I think they're challenged, in a word. My vantage point today is, as you mentioned, I'm on an insurance company, a regional mutual board in New England, a reinsurance brokerage board out of New York City, and then on the WSRB board, which I love because, WSRB is probably most similar to what I used to do at NAMIC. WSRB, we have subscribers, NAMIC, we have members, but serving companies in the industry and ultimately policyholders, through WSRB and the great team that we have there and the great board that we have there. We got to join a couple of old colleagues, Julie Rochman and Bob Hartwig, on the board, and then meet a couple of additional board members who predated us who were excellent. So anyway, that's kind of where I am. Plus, I'm advising a private equity firm and a venture capital firm on insurance-related issues. Both have insurance businesses. And I see what everybody, I think, is feeling in the industry, which is, it's a challenged market. What we have known about and worked on for decades now around technology is obviously still there. And we've layered on AI as a new factor that everybody is worried about and trying to evolve and adapt to, not knowing exactly what it will mean for our industry or for business or society for that matter.
Yeah.
But trying to negotiate that. We've talked for a long time about the talent gap, the insurance talent gap, as we named it, but just, you can't defeat demographics, and demographics are real in our industry where we have a seasoned workforce that knows a lot about insurance, that are retiring. I'm at the end of the baby boom era and retired a little early. So at 61, I'm part of that demographic. You are too. We're in that group that, can count our years of productive insurance work on one or maybe two hands, depending on how long we want to go. But that's a fact. And so dealing with the talent gap, replacing these retiring people who know a lot with new people is an issue. And then the real issues that are driving kind of financial results today, inflation. Nobody in our demographic group, really no one working today, few people have seen inflation like we've experienced in the last 3 years. And that is it's a major factor for insurance, as you'd expect, insuring assets that are going up in value and paying claims that cost more than they did 3 years ago. So rising property values, it's an issue. Then we have some other symptoms, and some related to insurance, others related to interest rate changes, like the way our reinsurance market has been the last couple of years. Rising reinsurance rates, increasing retentions for companies that make them, eat a lot more of the losses that they experience from cats, co-participations, et cetera. So it's another factor that industry is dealing with now. And then we have regulatory challenges. And this, in a way, is a symptom of some of the other factors. But regulators are trying to get their hands around some of these issues, ranging from AI and technology, and how do they deal with that as it's presented to them as an insurance solution. And then rate increases that have been a necessary part of the market that we're in. Different regulators have different perspectives on different time frames in terms of how they consider those rate increases, which obviously, when you look at the rate of inflation and other factors, are needed. And that's for like the broad industry. Then you look at a subset, which is in geographic areas. And you mentioned, I don't know if we were live when we were talking about it, but hail, the size of hailstones today, you mentioned football size. But if you're in the Midwest or the South or the West, you've had, additional elevated cat losses, and they have been really severe in many cases, driven by the secondary perils like hail, like wildfire in your part of the country. And some companies have really been hurt by this elevated cat experience. Last year was a record for severe convective storm. Globally at $64 billion insured, and 85% of that is here in the U.S. So these are, our companies. And then when you think about the mutual market specifically, I said we write almost 40% of the market, but mutuals are outsized participants in the homeowners, where it's 68% or something, and auto, I think it's around 56%. So the personal lines of the P&C world, which is the most under pressure, has had a negative outlook by AM Best now for a couple of years. That's where a lot of the pain has been felt, these property insurers, auto writers. So that's why we've seen, companies losing surplus, companies under pressure. I think the combined ratio of the mutuals last year was around 110, which is high. And the number of downgrades, 55 downgrades last year by AM Best, most of them in the personal lines market. I didn't see the mutual breakout, but I'm pretty sure most of them were mutuals. So that's kind of the trend. I'd add on just a couple other factors that are out there. We see agency consolidation, much of it driven by private equity, where firms are buying up, consolidating, rolling up agencies, which is changing the landscape since most mutuals deal exclusively with the independent agent market. So I think overall things are just moving faster, and companies are, forced to adapt.
Do you, of all those things you listed, and you listed most of the things I would be the most worried about organizationally, whether I'm a mutual or any carrier, which ones scare you the most?
Well, thanks for the comprehensive list. I had 2.5 hours to drive this morning, so I could think about them. But I would say, what always scares you the most is the unknown. And unknown is, two categories, maybe technology, which we have a hard enough time with. Companies have been dealing with now for a decade. In many cases for regional mutuals, it's a very tough to solve problem, whether it's just systems integration or now determining what AI may mean to the business going forward. We've seen technology help us a lot. We know that the experience of the pandemic, where we all learned we could work remotely and do events like this remotely, it's a great tool for companies. It helps, I think, relieve the talent gap that we talked about in terms of replacing retiring execs. And workers in the industry, now there's greater flexibility, particularly for mutuals that are often the biggest company in a small town. Getting people into that community to relocate is difficult. So having the flexibility of remote work is a plus from technology. But AI is just an unknown now. I know in the venture capital work that I do, every company now that's founded and has a solution for the industry has AI as part of their name anyway. Hopefully they talk the game in terms of having it as part of their business model. In most cases, I think that's part of it, but maybe not in all. So, and our companies, they're not, regional mutuals are not on the bleeding edge of technology, never have been, probably never will be. They just can't afford to be, and they don't have the bandwidth to focus on technology that way. So they will adapt as they have solutions that are brought to them by these insurtech firms, which may be acquired by other firms or maybe by companies, but that's how the innovation takes place in our industry and technology for the regionals. Now, larger carriers obviously have their own proprietary tech that's a great advantage to them in many cases. But in our case, we've really got to have somebody else develop it for us. So that's one category that most worry, just technology, period. How do these companies adapt and survive with AI as the latest and most worrisome of the category. And the second is climate. And this would be weather, as we see it, weather driving cats. We have had a very severe trend, as I said, in the last 2 or 3 years. We don't know what the future holds. Is this part of a very long-term trend where we have to evolve in a big way to deal with it, and the reinsurance market along with us will be evolving? Or is it more like, and I don't know if this is a good example, but I know in my experience we've had the 04-05 hurricane season in Florida, where so many storms reached landfall, caused tremendous damage, damage in the insurance market there, part of it caused by regulation. When affordability became a problem and companies were not willing, particularly mutual companies, were not willing to subsidize the Florida book with the rest of their policyholders, so they left. So anyway, but then we had 10 years of relatively calm Florida hurricane activity. And so do we know if after 2 or 3 years of severe convective storms in the Midwest, will we have a few years of a break or not? Even now, going back to Florida, we have, calls, not just Florida, but the entire Atlantic coast and Gulf Coast. We have, the most severe hurricane name storm prediction ever called for this year, and hurricane season has just begun. We know those things are never right, but you can look at the trend and just say, well, if it's half right, it's going to be a big year for hurricanes, and that's going to be a big year for the industry, paying claims for those storms. So I guess in the two, it's technology and then weather/climate. What does it mean? And I guess I'll add one more because it's related to both. Regulation. And it's where NAMIC works. It's where I used to work, but the regulator's response to both these issues, I think, is going to be important. It's already unfolding. But to the extent we see insurance, the old debate, availability versus affordability, this week or last, I saw Wall Street Journal had a story talking about Elizabeth Warren and the discussion around, her perspective on insurance affordability. There's a lot of, in the Wall Street Journal, was an editorial, and they're uh, editorial board had the position that most of these problems were caused by regulation, regulators not responding appropriately. So how they respond to the need for rate increases, how they respond to AI embedded in insurance products that they're going to have to understand and approve at some level. That's a big wild card that worries me some because there's a lot of different ways to regulate insurance companies, and companies that are in the markets that don't do it well will be challenged, and by extension, then their policyholders will be as well.
Yeah, I agree. I look at, so all three of those I think are extremely important. The regulatory one to me is depending on where you are, right? Where you write and who you, I'll say this, who you deal with in those, in the OICs in various states. California appears to be maybe moving towards a more reasonable approach now because markets are constricting on them, right? We've watched Florida have to do the same. And I understand, especially when they're in elected positions, right? You kind of got to be careful about what you do, especially as elections approach. And so I think that one it's a while. AI is so difficult to understand. I mean, we've had when I started in insurance, and that was a long time ago, right? We were building systems that allowed you to pass homeowners policies, right? So the system would automatically issue the policy if things on the application were done correctly, and you could verify through various reports, clue reports, and other things that it was a good policy to write, and the system would do that. So that's AI, right? That's artificial intelligence and machine learning right there. But the evolution of where it'll go, I read a lot, I watch a lot, and I don't even know what they're going to try and use it for, right? And I worry about if the claims aspects of it as well. I was on one recently where the gentleman from Lemonade was saying they did they managed the claim in 3 seconds, Joe, and that you got to have you got to make sure you're right if you're closing and managing the claim in 3 seconds. So it'll be interesting to watch, and I appreciate your insights. I think that the weather's a huge wild card as well. So.
When you say you've watched things around AI and its emergence, are you talking about things besides the Matrix, the movie, and the Terminator, the movie?
Yes,
because those are two.
Those are out there too, right? Think about the matrix of insurance, and that we have those. I mean, think of just the black box to generate the billion points of light to generate a policy and an actual premium. To think that the OICs, and I think they recognize this, are going to be able to uncover exactly how those things work. I think they struggle now with how algorithmic work, and actuarial work actually happens to get to a premium, let alone now if you add artificial intelligence to it as well. I don't envy the OICs out there trying to figure it out at all. So,
I would wait. While we're on technology, I'm going to turn the tables on you.
Yeah.
So one of the things we do at WSRB is technology
Yes,
and new tools that companies can use. You're involved with that stuff. Why don't you give us a sketch of what that is and how it can benefit these mutuals we're talking about?
Sure. Yeah. I mean, as a rating bureau, I think everybody probably understands a rating bureau. Most think about Verisk or ISO when they think about a rating bureau, and we're the same thing. We just happen to handle Washington. We've been doing it since, over 100 years now. And we've evolved, obviously, as we've gone to that. We've recently moved almost entire operations into the cloud, which I think we have to do for speed and efficiencies. And everything we do, from building loss costs to protection classes, keeps evolving and becoming better and better. We organizationally, from a technology standpoint, recognize that delivering things through an API, an interface, so that information falls right into an automated system for an underwriter, is vitally important. We built those, and we have a number of companies on them. The future will be even more of that information being able to be delivered to them. So if you request a commercial property report or an inspection, that stuff can be delivered through an API. we've also expanded our offerings because a bureau is, I love what a bureau does, but we always wanted it to be more than just a bureau here. And you've watched the evolution of us adding data elements nationwide, right? So some people have concerns about cannabis operations, and we knew that because we've got a large team of underwriting talent. And so what can we find at the address level that helps an underwriter price it right? I'm agnostic about, I think you can write anything for the right price. And so that technological delivery of those data elements and the next generation of more data that we're coming up, we are embracing technology. We haven't really, I mean, AI is one of those things we talk about. We're not sure exactly how that slides into what we do, frankly. But, you know, the companies about how they're using it, and then we think about what we might take from that and help them deliver something, because our goal will always be to help the insurance industry. I don't care if you're a mutual or if you're a stock or if you're an ESOP, it doesn't matter to me. I want the insurance industry to get stronger and stronger and smarter and smarter. And so we think about that all the time. We want to partner with companies who want that help, want to just have a conversation and chit chat about it. And then it helps us organize our thoughts about how we can help from a technology standpoint or information standpoint or data, whatever it is. So I hope that answers your question.
Yeah, it reminds me a lot, as I said, one of the things I like about WSRB is it's kind of like NAMIC in a way for the things I'm doing now. And you know, determining what the problems are for the companies you serve and then trying to find ways to solve them. I think is a big part of what we're doing at WSRB and the things you're talking about.
We're not going to reinvent a wheel, but if we can make it smoother, maybe a little quicker, able to handle 200 miles an hour versus 130, that's kind of how we think.
Well, I'm in Indianapolis, so it's got to be 220, which is how fast they go around the track. But yeah, 200 is a good start.
220, no, thank you. So we've talked a little. So the next question I would ask is how can companies adapt and evolve, and whether that be we're talking about mutuals. You've talked a little bit about regionals specifically. How can they adapt and evolve to not be so behind enough so that they can thrive into the future?
I think, I'm optimistic because I think these are some great companies, and I use regional mutuals. I think it's, the mutual industry is broad and deep. You range from the very largest national writers who are in a different category, and mostly I'm not addressing here, to regional mutuals that may be a couple $1 billion down to 300 or 400 million premium. And then smaller mutuals, often one state writers, would be the smaller size, down to farm mutuals, which are very small and write a subset of a state often. So you have to be kind of specific. When I like to focus just on regional mutuals and think about that area, that they're probably multi-state writers. They write a couple 100 million or above. So, you know, in terms of that group, there are challenges because of all those things I mentioned. It's hard to deal with the bad weather and the cats if they're occurring in your market year after year, and your market is only one state or two or three. Yeah. So that's a challenge. Technology for any company smaller than the national writers is a challenge, and more of a challenge the smaller you are. So that's a challenge. I think in terms of why I'm optimistic, it is, you know, these companies have a good history and capable management teams and alignment with their policyholders, so they have time to change. And I think because they're smaller companies, they can change more quickly. Large companies, they may want to change, but it's going to take a while to turn the ship. Smaller companies, much more agile, but they have to choose to be agile. And this gets me to a concern I have, which I would urge companies to avoid. I wish I could take credit for it, but it was the reinsurance broker that I'm on the board of where I heard it first, and that is optimism bias. You know, we have this, and I've heard it 1,000 times, and it's true. So a mutual exec talks about, I'm worried, but we've survived 100 years. We've been through 2 world wars, and the Depression, and the great financial crisis. So we'll survive this. I think that is a dangerous attitude today, because this is different. And now you can say every year is different, but I really do think things are changing faster, and there is more flexibility needed, more solutions needed than ever before. And I'm worried that some companies that figure if they just keep their heads down and plow through it, they'll make it to the other side, may not make it to the other side. So avoiding optimism bias, I think, is essential. And then the other thing that we know is just a fact of life with these companies is they can change fast, but they can only change so many things at a time. So every year, and I've again heard from mutual execs about, we can do 5 things. Every year we have to pick 5 things, really no more. We don't have the bandwidth for it. We don't have the management team to handle it. We can't afford it. So what are the 5 most important things? And those, I think, are those things that will address the factors that we've talked about. I think there's also some positive signs. The reinsurance market, which has been a very hard market, I think capital in the reinsurance market is moving around more freely, which is good. It's kind of a perfect capital market in a way, because there's really no regulation. Capital moves wherever it gets the highest return, and it seems like it's stabilizing, and so companies can build around that. It's very important for regional mutuals to have good reinsurance treaties that support their business. So I think that's a positive sign. We talked about technology as a threat. Technology is also a great opportunity, potentially a great equalizer, because if you have that killer tech app that helps your company do better, even for a period of time before your competitors catch up, that's a great advantage. And technology is getting more cost-effective, more useful every day. And there's new creativity, mostly through that venture capital supported insurtech space that I mentioned, where companies are trying to bring solutions to our industry that will really, really help mutuals serve their policyholders. I think I mentioned the evolving. I did mention the evolving distribution force, but I think there are opportunities here for mutuals. There's some stresses, which is you're not dealing with a mom and pop agent that you knew and that was part of your special group that did the most business and were your best business partners. You're now dealing with one that's led by some centralized office that has more in premium written through the agency than you have in your company.
Right.
So you have to be careful with the dynamic, but in many cases, I think they're helping companies evolve and change. They're probably less interested in, agent incentive trips, for example. They're probably more interested in having a stable business partner they can count on to distribute the product or to underwrite the product they distribute, and to pay them, fair commissions on that product. So I think that doesn't have to be a negative, though it's something you have to plan through and be aware of as a mutual. Finally, I think I just talk about something I remember from a NAMIC convention a few years ago. I'm a fan of Jim Collins, and Good to Great, his best book in my view. He came and spoke to the NAMIC annual meeting a few years, more than a few now, a decade ago. But in a lot of ways, and most of you probably have read Good to Great or know the lessons in it. But in many ways, the mutuals are a representation as an industry of the Good to Great concepts that he talked about. And one was hedgehog. He talked about the hedgehog concept, which is, do something that you're passionate about. This can apply to individuals or companies, but do something you're passionate about. Do what you can be the best in the world at, and then do what drives your economic engine. But the point is, be very focused. And I think part of the strength of our regional mutuals is they are often very focused. They behave, in hedgehog-like ways, which is a plus. Who knows that market in that state or in those two states better than this mutual that is focused on it for 120 years and understands the policyholders and the business that is writing. Who is more committed to it? There's no place else to go. That's your market, and you better figure it out. Know it. And if things are changing, you better figure out how they're changing. So I think there's strength in that concept that mutuals already have shown, over the decades. But I think doubling down on it now, really knowing what they know, may involve some focusing. I mean, there's still a lot of generalist mutuals that write, half commercial lines, half personal lines. They're not really great in comp, but they got to write it as a concession to their, rest of their commercial lines book. I think more specialization is more likely with, in this market, because it's hard to be a small generalist.
I would say that's extremely challenging, having a BOP in today's world, which is fundamental, that you probably ought to have one if you're going to write small commercial. But to compete against some of the automated systems out there, it's a challenge. I mean, it's a way big challenge for a regional. And I think that it's okay that they figure out technologically how they can keep up, or what their value proposition is for their customers that keeps them in the fold, right? And I agree with you. I think mutuals have every option, because they're local. Many of the regionals have the option to talk to their customers more and to make sure what they're doing aligns with their customers, because that should be what they do. And from every indication I've seen in companies I work for, that is what we do, right? We talk to our customers all the time about what they want, and we try and deliver that. But that's great. I appreciate that. We kind of already talked about what's the outlook in the long-term future. Would be there more you'd want to add there before we either?
I wish I had more answers that I would. I had a whole list of challenges and fewer answers, but I don't know. I think it is, technology will help a lot. It will make things more challenging a lot, and there's no easy answers there. But we know that's a fact, I believe, and so companies that deal with it well and find the right solutions for their policyholders will survive and thrive. And those that fail at whatever it is, often kind of a system conversion or making the wrong decision or spending too much money, will, struggle. And so, and it also, we didn't talk about it specifically related to the distribution, but I'm also optimistic that, mutuals are often kind of wholesale businesses with the agent as the front end face. But I think as technology is developed for mutuals, and you have slick apps and things that help you with the claim. And I think most lemonade examples are not worth bringing up or using, although I understand why you did, but I just, I try not to. But I think the AI-driven, claims solution, coupled with the front end, interface between the company and the policyholder, has the potential to really create stickiness and bring the mutual to the fore like it hasn't been before, because the agent's in the middle. Not the agent doesn't have an important place, but I like the idea of the company having more of an identity with the customer. And so I think that's a silver lining for technology as well.
Yeah, I agree. I think that there's a happy mix between those things, Chuck. I think that's a great way to think about it, is that as our next generation of insurance buyers, the ones after that, they're going to want things differently than we're used to. It's not a handshake. It's not, I'm not going to the agent's office to, have coffee with them. I want it fast, efficient, and I want to know that I'm taken care of when something happens. And that can be done technologically. And those who are embracing that, and there are a number who are, they're being very effective at that, but also still having a relationship with the customer, which doesn't matter how you do it. Retaining those people and giving them the value they're paying for is ultimately what's going to decide if they're staying around or not. So,
Totally agree. And that's again, we can go all the way back to demographics. So in fact, dealing with my independent agent in the last 2 weeks, have moved my book to a new company, another great mutual insurance company, saved a lot of money in the process, and have great coverage. So I love my agent for doing that for me. It's complicated. I would not be comfortable doing it on my own. Um, my kids, any of our kids, the next generation, although I've introduced them to my excellent independent agent, they go direct. They live in other states now. That complicates things, but they don't like calling people. They don't do things our way. So it's got to be through, an app, the web, um, email, texting, ideally. So they don't even open their mail.
No, they don't. Did you get that? Did you get your renewal? Well, did they send it to me in the mail? Yeah. Then no.
Yeah, exactly. So that is something that the industry will evolve.
Yeah, we will. And we're smart. I mean, the industry is smart, right? And mutuals are smart. Everyone I've worked for has just been really intelligent, and yet they're limited on their resources. So, like you said, they got to pick the few things. You got to pick the not just low hanging fruit. You got to get the top stuff too. But over time, most of them have a really strong strategic plan of where they're going, and it just takes a little longer to execute when you can't empty your coffers with the $1 billion in surplus you don't have any, because you don't have that much. So you got to be careful. We got a number of questions in the Q&A, so I'm gonna read through them to see which ones are. So we've got one says, Chuck, what would you say to organizations that lean older, and what should be their strategy with replacing the aging workforce without skipping a beat?
Well, that's a very difficult question. We know we have more flexibility with remote work. We also know that most insurance is learned inside regional companies. Like, it's learned through industry education, but it's also learned through kind of an apprenticeship model, which is you're an underwriter sitting next to another underwriter. You're a claims guy meeting over coffee with somebody else talking about a tough claim they have. That's how you learn, and that is very difficult in remote environments. So I don't know the actual answer. I know a lot of companies are working on it, and a lot of the solutions will be specific to the company. But I think it's being addressed. It has to be addressed. Obviously, you should talk about an older company, which I assume means a company with older executive leadership.
Yeah.
It'll turn over. And the other thing I think mutuals are good at is bringing from within new leadership, and sometimes it's very deliberate. I've seen elaborate training programs and executive leadership programs with larger companies, but also with others. Driven by board work often, as it should be. Excellent succession in a stable company where even the second and third exec have been there for a long time, and they're ready to step up as the CEO retires or needs to be replaced. So I think it works. I can't say that I have a great solution for a universal way to approach it, though.
I've watched companies where I'm connected to people who are my generation, getting towards the sunset of my career, let's say, in a nice way. And almost every one of those companies has found that next generation of people who are intrigued by our industry, right? And I know that what we do is incredibly valuable. I mean, I think insurance is sexy, and I know I'm a nerd about that, but I mean, I really believe in what we do and how we do it. And we could do a better job evangelizing that, or to the world. But I do believe it's happening. I mean, I'm watching it happen, and I think it's cool to see young people taking on the challenge of insurance. And it won't look the same as when you had a stack of files on your desk 10 feet high and you had to work them. But but it'll appeal to their desire to be innovative at their desk, which I think it's a very exciting time for insurance in my mind. All right. So another question is, what publication do you read regularly to stay up to date on mutual news, but then also just industry news?
Yeah, this has been one of my biggest challenges since retiring because I'll just answer. Today I read industry publications from Business Insurance to AM Best publications. I certainly read NAMIC and everything that they put out, particularly, the overview of the mutual insurance industry. I get the emails and issue briefs about, because the company I'm on the board of is a member of NAMIC, so I'm counted in the group. But I get updates on legislative and regulatory developments, and I get a whole host of email newsletters ranging from those focused on reinsurance to private equity, venture capital, and then primary insurance. So it's not a perfect system, though. I wish I had a better one, and I just had a lot of smart people who work for me around at NAMIC who could answer any question and wrote papers on any issue that we needed and dealt with some of these things for our members. So it was easier to stay up to speed then. But I think I've got enough roles that go into different parts of the industry. So I do know a few things I didn't know before, because I see, the reinsurance brokerage, at work through quarterly meetings. I see the, Pacific Coast business focus of WSRB and the way companies out there are operating. So I have some better sources of information too now.
I appreciate that. I know you're on the board of an exceptional mutual in the Northeast. Question here was, well, I know you would know if they are working on anything really cool by chance.
That company in the Northeast?
Or just your exposure, but yeah, this was specifically to asking that you are involved with and working with. Any insights on projects or ideas that you could share? If you can't share, I understand.
I would say all the companies I'm working with, including WSRB, of course, are working on a lot of cool stuff. These are companies, I picked them because the companies are great and the people are great.
Yeah. So
that was kind of my two criteria for what do I want to do in retirement. But I don't think most of them are doing anything radically different than the rest of the industry.
Okay.
Everybody's trying to figure out the next steps.
Excellent. Another question. So wouldn't some level of regulation or perhaps ethics reform in the legal profession have a more immediate effect than state-to-state insurance regulations? This is a little more.
I love this question.
That's a good question.
And it allows me to go into something I left out on the Q&A part of our discussion, which is, so we brought up the question of the regulators and the insurance availability versus affordability. And then, of course, we can go into what is affordability? How do you define it? NAMIC has looked at that and it's impossible. But, we know that auto insurance rates are up 46% since the pandemic. That's a fact. And that's driving this debate. But, what's driving that? More accidents by more expensive cars, more expensive parts, and then getting to this question, lawsuit abuse, which is around bodily injury and any of the, auto claims you talk about. And I'd say less law enforcement post-pandemic around things like auto safety. I just drove on highways this morning. I don't think I'm making it up that everybody drives 10 miles an hour faster than you did back in 2019.
Agreed.
And people, again, distracted often. And probably less law enforcement. I live in downtown Indianapolis. I feel like there's less concern about property damage. I had a car stolen a few years ago. It was my son's truck. But and this was pre-pandemic, but I think this is a trend we've seen for some time. There was not a lot of concern about recovering the stolen vehicle. Not like in Ohio, where I used to attend the Ohio Insurance Institute's annual session with the state troopers, where they would award them. They would all invite them to these things if they recovered the most stolen vehicles in Ohio, which I think is a very clever program that every state should replicate. But so then those are all trends. But then 46% increase in premium is a lot. But auto repair costs are up 48%. And getting to this question, litigation abuse, along with rising medical costs, makes the average bodily injury auto claim 80% higher than in 2014.
Yeah, I believe that.
And again, boy, I'm getting a lot of experience out of my drive this morning. Is the highway in Indiana lined with, big truck accident law firm specialists? I'm not going to name them, but at least one national writer or national law firm that started down in Florida and has unfortunately spread like kudzu all around the rest of the country, or like wild pigs too. You can say that, but so yeah, this is driving it, and it's litigation, it's lawsuit, litigation lending, which NAMIC has been working hard on for some time. It's driving the social inflation that we started to talk about 10 years ago, and we don't have under control. And, you can look, Florida is a microcosm of it, and where it's affecting homeowners, where you saw the assignment of benefit fraud that took place all throughout Florida that made a huge difference in the property insurance rates. And, homeowners have enough to worry about down there with risk of hurricanes, let alone the, lawsuit abuse that is kind of a man-made catastrophe.
Yeah, that's a great question, a great answer. So here's one which I think we didn't get. You mentioned downgrades. So this is many mutuals have been challenged with rating gap downgrades as surplus has degraded, which we've all watched. Large private equity agencies will move away from the mutuals who fall below an A-. As you mentioned, tough to do business without these relationships. What are some ways you're seeing mutuals react to this risk to their business in order to meet the challenge of that potential downgrade or loss of surplus?
Well, yeah, that's a very tough challenge, because we point out mutuals for the most part rely on independent agents to distribute their product. If you're an independent agent that has certain standards for company rating, because you're larger and part of a big group, you probably won't deal with companies that aren't investment grade. And I've seen it happen with some companies recently. They've kind of restructured their entire book. This is fire alarm time, because in this one, there was some specific commercial lines business that was being done, and it was kind of wholesale, and they just couldn't do it, having been downgraded. I think for others, in less severe cases, it's harder with private equity roll-up agencies. But some companies still have the ability to write even commercial lines locally through agents that know them and will continue to support their business. But I think the only solution is you gotta get back to a reasonable rating, and that's not an easy solution, and it's not a quick one. But there are companies are taking surplus notes. Companies are doing other creative ways to support their business, and I think affiliations will continue in the mutual space. So it's a challenge. No easy answer there.
Yeah. So another question, which you said affiliations, I think speaks to that. Do you anticipate increased M&A activity in the mutual insurance company space over the next 5 years? And if so, why?
I do, for all the reasons we talked about. Because there will be companies that evolve and adapt and start their next 200 years. And there'll be companies, and this is a characteristic of mutuals. I'm sure many people listening recognize it, hopefully not in their own company, but We can be slow to move. Again, that optimism bias can figure in. We'll be fine. Just put your head down and get through it. And sometimes and we have the advantage, which is being aligned with policyholders, serving and aligned with and focused only on policyholders. You don't have the outside pressure that a stock company does that's just had a couple bad quarters, making their investors unhappy. So without that discipline, the mutual has to be proactive and ready to change as quickly as possible. Hopefully, based on the right answers that they've concluded, they need to make through their executive team and board. So I think for those companies that don't evolve, they'll be affiliated, over time, which is, kind of a natural part of the creative destruction of business, but it's not a pleasant one. And where you lose a local company headquarters, where you lose a tradition and history, and the agent loses a market, it's best prevented, and best prevented by companies, evolving and improving.
Yep, I agree. Last question we have, Chuck. Do you see us moving away from having more agents in the field with the evolving platform of doing business with apps and web-based technology?
I don't know. I'm not sure. I think, most mutuals are very committed to their independent agent force. And I think more are working on alternative service structures like service centers, which kind of supplement the agency role. So if that's what you're talking about, yes, I think there'll be more companies finding more ways to engage with their policyholders through technology. But I'm not sure that it will cause fewer agencies. As I said, I'm really not sure, but I'm not sure I see that.
Yeah, I think there's always going to be a group of people who want to talk to somebody, and I don't think that'll change just because they get younger. I think there'll always be that necessity to have somebody, especially in complex commercial accounts, even non-complex commercial accounts. If I was running a business, I certainly would want to talk to somebody to help me through that process. And personal lines the same way, but I just think, I think that too many people are saying personal lines is easy to handle. There's a lot of challenges to personal lines, just like there is in commercial. So, all right. I think that's our last question. Anything you'd like to add before we call this a day, sir?
Well, I just saw somewhere scrolling up, I can't read it now, but I did see someone earlier say, if the mutual insurance industry had a movie, what would it be?
John, yep, I see that one. What do you think?
I think I've got the movie.
Okay, go.
It's a Wonderful Life. So George Bailey runs the small SNL. Mr. Potter runs the big bank in town. But George explains, and in George's life, for everybody who's seen the movie, which is probably everybody, you see what would have happened if the Bailey Building and Loan hadn't been there, and this neighborhood wasn't developed, and town ended up a pretty dark dystopian place if they hadn't been there. But because they were there, and this is the role I put our mutual insurance companies in, infrastructure is built through the bonds that our industry holds above all others. Obviously, claims are paid. Commerce can happen. People can buy things that otherwise they couldn't afford, to replace. People are protected from catastrophic loss, and you could see in It's a Wonderful Life, parallel universe, what would happen without us and mutual insurers over the last 200 years. It would look a lot like Potterville, which is, the dystopian alternative part of Bedford Falls. So anyway, that's a movie I would pick, and I think it could hold up.
I like that. Maybe I'll start working on a movie for the insurance industry. Yeah.
Brian Capra.
There you go, Brian Capra. Brian something. Thank you so much for spending time with us today. It was insightful, and I appreciate, as always, talking to you. And I hope our group who sat in with us felt the same way. Appreciate it.
Thanks, Brian. It was a lot of fun, and I really appreciate it.
I'll see you at the next board meeting, sir.
See you then.
Thank you all for being here.